Hi, welcome to Main Street Macro. I'm Neela Richardson. I started my career as a PhD economist in the housing market, or to be more specific, the mortgage market. And back then, I used to think that there is nothing more local that you could buy than a haircut and a house. Well, friends, I got it half right because while haircuts will always be local, housing in the United States definitely is not. You see, the Federal Reserve is not the only entity that affects interest rates in the United States. Actually, the buying and selling in US bonds around the world has a big impact on the interest rates that is paid by Main Street. So, in today's blog, we take a look at the global footprint of the US bond market and how that path leads straight to Main Street. The first point you should know is that there is a high foreign demand for US debt. Now, the US issues a lot of debt. We're about 40% of the global bond market. On the flip side of that is that federal purchases of US debt accounts for about 30% of bond holdings. Last week, data from the US Treasury showed that foreign investors bought net positive US debt for the third straight month, $74 billion in January to be precise. That's up from 44 billion in March and the highest level since March of last year. The second point about foreign demand is that it helps keep interest rates low. Last week, we saw that the Federal Reserve kicked off its interest rate hiking cycle. The counterbalance to these interest rate hikes is foreign investor demand, at least in part. You see, investors are willing, when there's a lot of enthusiasm for an asset, they're willing to accept lower yields and therefore lower returns. In fact, with inflation this high, bonds are not as profitable as they used to be. Still, investors are enthusiastic. Why? Well, for three main reasons. One, US bonds are highly liquid, which means investors can buy and sell them pretty easily. Two, they're safe. They're usually backed, at least government bonds, by the full faith and credit of the US government. And they serve in that capacity as a safe haven for investors looking for safe returns. And three, well, when it comes to bond yields in advanced economies, the US market offers the highest yields in the world. So, for all these reasons, even though rates are low, they're still attractive. The final point is that global footprint leads straight to Main Street's front door. The last time inflation was this high, mortgage rates were over 15%. Now they're under 4%. One key reason, it's because investors, and especially foreign investors, don't just buy US government bonds and treasuries. They also buy bonds tied to US mortgages. That keeps interest rates low. And even though rates may rise a little bit, there is again that downward pressure on mortgage rates, which brings the global capital that's in the world right to your front doorstep. Now, we've talked a lot about the connection between Main Street and the global economy. Here's one place where that connection and link is very tight. Foreign investment in US bonds help make borrowing costs on Main Street lower and much more affordable. Thanks for watching the Main Street Macro. For more information on the week ahead and a deep dive into the Federal Reserve's recent rate decision, please go to adpri.org.